Unit Learning Outcome C. So this is to continue the discussion for income taxation. This time, we'll discuss taxation of corporation. First, we have to define what is corporation. Okay. Corporation is an artificial being created by operation of law having the right of succession and the powers, attributes, and properties expressly authorized by law or incidents of its existence. So, this is the definition given by Section 1 of the Batas Pambansa bilang 68. Now, for purposes of taxation, there are different types of corporation as to where it is or what country does that corporation is incorporated. Okay, so una, we have domestic corporation. That's one incorporated under the laws of the Philippines. So in general, domestic corporations, government-owned and controlled corporations, taxable partnerships, proprietary educational institutions, non-profit hospitals. Next type is we have the foreign corporation. So by residual definition, those corporations that are not incorporated under the laws of the Philippines is considered to be foreign corporation. And foreign corporation is further classified into two. You have the resident and non-resident foreign corporation. So a resident foreign corporation are those engaged in trade or business within the Philippines, while non-resident foreign corporation are those not engaged in trade or business within the Philippines. So kinds of corporate taxpayers. So again, you have to classify or you have to know what type of taxpayer is a corporation. Okay? So as what we have discussed, maybe it could be domestic corporation or a foreign corporation. So nganong importante siya? Because if the taxpayer is a domestic corporation, both the income within and without or within the Philippines or outside the Philippines will be subjected to income tax. While if the taxpayer is a foreign corporation, only those income derived within the Philippines will be subjected to income tax. For domestic corporation, we have the different tax rates or applicable tax rates. Una, you have the 30% regular corporate income tax. You have the 2% minimum corporate income tax. You have the 15% of gross income tax. So for the 30% regular corporate income tax, you have the pro forma computation. Also for the 2% minimum corporate income tax, you have here the pro forma computation. Okay, so illustration number 1. So this illustration is based on, or this illustration will show us how to compute the regular corporate income tax. So it is a domestic corporation, has the following data on its income and expenses for 2019. So the corporation or the domestic or said domestic corporation have gross income for or from the Philippines and USA, and also my business income from the Philippines and USA, royalties on Philippine copyrights, interest on time deposit, PNB Manila, Philippines, and my payments for the first 3 quarters. Okay, so to compute the taxable income and tax due, you first get the gross business income. So because the taxpayer is a domestic corporation, therefore, both the income from the Philippines and from USA will be subjected to income tax. So the gross business income is 12 million less allowable deductions from the Philippines and from the United States for 3 million. That gives you a taxable income of 9 million pesos. So to get the tax due, you base it on your taxable income. That's 9 million multiplied by the regular corporate income tax rate of 30%, then that leaves you 2,700,000 as tax due. So remember, your 2,700,000 pesos tax due is not your tax payable because for the past 3 quarters, you have already paid 100,000 pesos. So, 2,700,000 pesos as tax due, less 100,000 pesos payments for the past 3 quarters, then your tax payable is 2,600,000 pesos. Remember that in computing the gross income, you do not add royalties and interest on time deposit because they are passive income subject to final tax. Now let's proceed to illustration number 2. Gene Company opted to use optional standard deduction in computing its tax due. The following relates to its results of operation. So Gene has a gross sale of 4 million, sales returns and allowances of 100,000 pesos, a sales discount of 50,000, may cost of sales na 2,500,000 pesos, recorded admin and selling expenses of 750,000, dividend from domestic corporation of 50,000 pesos. So to compute the taxable income and tax due using optional standard deduction, you first have to compute or to know where 40% will be multiplied. We have already discussed this in individual taxation. Alright? So let's proceed with gross sales. 4 million less sales returns and allowances and sales discount of 150,000 pesos. Then that gives you a net sales of 3,850,000 pesos. Less cost of sales of 2,500,000 pesos. So your gross income is 1,350,000 pesos. Remember that your optional standard deduction of 40% is based on the gross income of 1,350,000 pesos. So that's multiplied by 40% optional standard deduction. That gives you 540,000 pesos. So, as you can notice, unlike the computation for the optional standard deduction on taxation of individual taxpayers, the 40% OSD is based on the gross sales or net sales if there is sales returns and allowances or sales discount. You multiply the 40% to the gross sales or net sales without regard to the cost of sale if it happens that the taxpayer is individual. However, if the taxpayer is a corporation, you have to deduct from net sales the cost of sales to get the 40% optional standard deduction. So again, the treatment or the computation of the OSD is different from when the taxpayer is individual and when the taxpayer is a corporation. So moving forward, 1,350,000 pesos minus 540,000 pesos, that gives you a taxable income of 810,000 pesos multiplied by the tax rate or the regular corporate income tax of 30%. That gives you a tax due of 243,000 pesos. So the determination of the amount of OSD for domestic corporation and resident foreign corporation is as follows. Letter A. In the case of corporate taxpayers, the OSD allowed shall be in an amount not exceeding 40% of their gross income. The gross income shall mean the gross sales less sales returns, discounts, and allowances and cost of goods sold, unlike OSD in individual taxpayers where, as what we have discussed earlier, that the 40% OSD will no longer include the cost of sales. So in the case of sellers of service, the term gross income means gross receipts less sales returns, allowances, discounts, and cost of service. Illustration 3. Mia Corporation, a domestic corporation, opts to be taxed under the gross income taxation for the taxable year 2019. Its financial records show the following. So going back to the types of applicable taxes for corporation, okay, so the 15% gross income tax. So here are the qualifications. The first is that the cost of goods sold, or the ratio of the cost of goods sold to gross sales or receipts, should not exceed 55%, and this for further qualification. So Mia Corporation has a gross sales of 15 million, a sales returns and allowances of 600,000, 450,000 as sales discount, cost of goods sold as 6,750,000 pesos, and deduction of 3,375,000 pesos. So compute for the gross income and the gross income tax. So for step 1, you have to test whether the cost of goods sold ratio does not exceed 55% of the gross sales receipt. So how? You just have to divide 6,750,000 pesos as the cost of goods sold divided by 15 million as gross sales. So the answer is 45%. So therefore, the ratio of the cost of goods sold to gross sales is less than 55%. So therefore, it can be taxed at gross income tax provided that it qualifies to the other 4 qualifications. Okay, so step 2, compute for the gross income and gross income tax. So you have a gross sales of 15 million less sales returns, allowances, and discounts. That gives you a net sales of 13,950,000 pesos less cost of goods sold for 6,750,000 pesos. That gives you a gross income of 7,200,000 pesos times 15% gross income tax. That gives you 1,080,000 pesos. Now, baka ma-confuse kayo kung kailan gamitin si 15% gross income tax, si 30% regular corporate income tax, at saka si 2% minimum corporate income tax. So, sa general 15% gross income tax, okay, pwede siya piliin ni corporate taxpayer provided na nag-qualify siya sa mga hinihinging qualification. Of course, if the corporation is taxed at 15%, hindi na siya pwede i-tax ng 30% regular corporate income tax. Next illustration. For taxable year 2019, JJ Company providing massage service opts for gross income taxation and has the following data. So, illustration number 4 differs from illustration number 3 in such a way that illustration number 3, which is Mia Corporation, is what? Is selling goods, while under illustration number 4, JJ Company is providing service. So, if the taxpayer opts to be taxed at gross or 15% gross income tax, there is a difference between a service concern and a manufacturing, merchandising, or trading business. Because in the computation of the gross income, under trading, merchandising, and manufacturing concerned businesses, cost of goods sold will be deducted. While if the taxpayer or if the corporate taxpayer is offering services, the computation of the gross income, in the computation of the gross income to be multiplied with the 15% gross income tax, the cost of service is no longer deducted. So in this case, again, the first qualification is that the cost of service, no, should not increase, or the ratio of the cost of service to gross receipts should not increase, should not exceed 55%. So 4,450,000 pesos divided by 11,200, that's 44.20%, lower than 55%. So it could, or it qualifies to be taxed at gross income tax. However, in the computation of the gross income, you no longer deduct the 4,450,000 pesos cost of service. So, to compute gross income, if the corporate taxpayer is offering services, gross receipts of 11,200,000 less sales returns, allowances, and discount, that gives you a gross income of 10,750,000 pesos. You multiply it by 15%, and that gives you the gross income tax due of 1,612,500. So another type of taxable corporation is a proprietary non-profit educational institution and hospital. So what are the applicable tax rate? So pwede 10% or 30%. 10% of taxable income, or 10% of taxable income except for passive income, or 30% on entire taxable income if gross income from unrelated trade or activities exceed 50% of the total gross income. So in general, proprietary non-profit educational institution and hospital are taxed at 10% income tax. Again, however, if their income from unrelated activities exceeds 50% of the total gross income, then such a proprietary non-profit educational institution and hospitals will be taxed at 30% regular corporate income tax. So proprietary or private non-profit, no net income or asset accrues to any member or specific person. All net income or assets are devoted to the institution's purposes and all its activities conducted not for profit. For proprietary educational institution refers to any private school maintained by private individuals with an issued permit from the ECS or SHED. So these are the definition of a proprietary educational institution. Okay, so requisites to be entitled to reduced 10% corporate income tax. It must be both proprietary and non-profit. So the ownership and the purpose should be present. It should be proprietary and non-profit. And the income from unrelated activities must not exceed 50% of total gross income. So, ano ba yung sinasabi niya na unrelated activities? So, unrelated trade, business, or activity means any trade, business, or other activity, the conduct of which is not substantially related to the exercise or performance by such educational institution or hospital from its primary purpose or function. So, example, See, educational institution, of course, the primary purpose or the primary activities of an educational institution is to what? Deliver, to, to provide education, okay? To give learnings to its students. So what are the related activities of a hospital? Okay? To collect tuitions. Pag may bookstore si educational institution sa campus, of course may income 'yon. Still, it is a related activities. Pag may canteen si educational institution, of course, related activities yon kasi necessary yon si canteen sa loob ng campus. However, if si educational institution may building siya, may vacant building spaces siya, tapos pinarentahan niya sa iba, okay, at nag-earn siya ng income doon, then that income is considered to be unrelated activities which will be used to compute whether unrelated activities exceeds 50% of the total gross income. Because if those unrelated activities, so if yung income niya sa mga extra building spaces niya na pinarentahan niya, if yung income niya doon nag-exceed ng 50% sa total gross or sa gross income ni educational institution, then hindi na siya mag-qualify sa 10% reduced income tax. Okay? The entire income in such a case will be subjected to a 30% regular corporate income tax. Illustration 4. To illustrate, Abacada University, a non-profit educational institution, reported the following during the year. So, meron siyang mga related activities, unrelated activities, tapos ito yung totals. Okay, so may gross income, less deductions. Ayan, so to compute for the tax due, step 1 is the predominance test. So, dito na yon iti-test mo if yung ratio ng unrelated activities is within the threshold of 50% to the total gross or to the gross income. So in this case, you use the gross income, not the net income. So gross income from unrelated activities of 1,500,000 divided by the gross income of 3,200,000, that gives you 41.66%, which is less than the 50% threshold. Therefore, it is qualified to use the 10% tax rate because the income from unrelated activities does not exceed 50%. Now, for step 2, you compute for the tax due. So, of course, you have the taxable income of 1,300,000. You multiply it by 10%, then the tax due is 130,000 pesos. Let's proceed with illustration number 5. Romantic Doctor Hospital, a non-profit hospital institution, reported the following during the year. So, the same as illustration number 4, nakaseparate na si related activities or income from related activities and income from unrelated activities, and of course, totals. So, predominance test again, step 1, you divide the income from unrelated activities by the total or the gross income of 5,100,000 pesos. That's the result is 68.63%. Therefore, yung unrelated activities niya na 3,500,000 is more than 50% of the gross income of 5,100,000. Therefore, it does not qualify with the 10% reduced income tax. And therefore, it will be taxed at the 30% regular corporate income tax. So to compute the tax due of Romantic Doctor Hospital, that's taxable income of 3,200,000 times the 30% kasi nga again, it did not qualify because it's unrelated, the ratio of its unrelated activities to the gross income is 68.63%, which is higher than the 50% threshold. So the tax due of Romantic Doctor Hospital is 960,000 pesos. Now, for GOCCs, agencies, instrumentalities, again, GOCCs are part of corporation in taxation, also agencies and instrumentalities. So the tax rate again is also 30% corporate income tax rate on taxable income except so kasi class si GSIS, SSS, PHIC at saka LWD, they are GOCCs. However, they are exempted from paying the corporate income tax. Silang apat. Now, corporations also have passive income. So may income din si corporation, hindi lang sa regular operations niya. So may passive income din siya. So for domestic corporation, ito yung mga passive income niya plus the tax rates or final tax rates. So interest income on any current bank deposit or deposit substitute, that's 20%. Royalties of all types within Philippines, that's 20%. Interest income on foreign currency deposit, that's 15%. And dividends received from domestic or another domestic corporation, that's exempt from income tax. Okay? So, depository bank, interest income on foreign currency deposit from transaction with non-resident offshore banking units, that's exempt. And interest income on foreign currency loans granted to residents other than OBUs, that's 10%. Now, for capital gains or capital gains tax, okay, ito yung tax na applicable for the sale of shares of stock or for real properties. Okay, for shares of stocks, if the sale of share of stock is not traded in the local exchange or local stock exchange, then the tax rate or the capital gains tax is 15% of the net capital gains. So, may formula pa rin on how to compute the capital gains. Okay? You multiply it by 15%, then that is the capital gains tax. Remember that in order for the 15% capital gains tax to apply, it must be that the shares of stock is not traded in the local exchange. So in this case, dapat daw hindi siya naka-trade sa, for example, in the Philippines, hindi siya dapat naka-trade sa Philippine Stock Exchange. If the sale of shares of stock is listed and traded in the local stock exchange, then hindi na mag-apply si capital gains tax. Yung mag-apply na is si stock transaction tax, which is 6/10 of 1% or 0.006% of the gross selling price or gross value in money of shares of stock. Now, for real property, of course, that's land and building. Sale of real property in the Philippines held as capital asset. Okay? So, the tax rate is 6% of the gross selling price or the fair market value, whichever is higher. So, it doesn't matter, class, if si domestic corporation nagbenta ng land or ng capital asset, ng land or ng building, okay? It doesn't matter if it resulted in a gain or loss. Kasi, the basis of the 6% capital gains tax is on the gross selling price or the fair market value, whichever is higher. If the sale is made to the government or in GOCCs, if the taxpayer class is individual, it has the capacity to choose to be taxed at either 6% of or the graduated rates kapag yung sale is or yung buyer ng real property is the government. However, it is not the option to be taxed at 6% or the graduated rates is not available if the taxpayer is a corporation. So sale of real property is held as ordinary asset. Okay, so if it is an ordinary asset class, uh, if the seller is habitually engaged in real estate business, so when you say ordinary asset class, ito yung ordinarily binibenta niya. Ito yung mga asset na ordinarily binibenta. So for example, inventories, okay? So seller is habitually engaged. If the seller daw is engaged or habitually engaged in real estate business, then the creditable withholding tax is based on the depende sa amount ng selling price. So iba-iba yung rates depending sa amount ng selling price. And if the seller naman is not habitually engaged in real estate business, then 7.5% of gross selling price or fair market value, whichever is higher. Kasi nga in this case, yung ordinary asset niya, if the taxpayer or the seller is not habitually engaged in trade in real estate business, para na siyang maging capital asset niya. If seller is exempt from creditable withholding tax, exempt yung binabayaran niya na of course creditable withholding tax. Now, if you can remember, kanina, the applicable tax, we discussed the applicable tax. There is the second one, which is the minimum corporate income tax or the MCIT. Applicable to both, only to both domestic corporation and the resident foreign corporation. So, walay labot si non-resident foreign corporation. MCIT is implemented on domestic and resident foreign corporation when they have zero or negative taxable income, or MCIT is greater than the regular corporate income tax. So sa letter A, of course, hindi pwede na walang kolekta na tax si government. Kaya kahit pa wala kang income or zero imong net income or negative imong taxable income, you could still pay corporate income tax because there is MCIT. Okay? For letter B, if MCIT naman is greater than the regular corporate income tax, then you have to pay MCIT. Okay? We discussed this kanina, yung pro forma computation. If MCIT is higher than the regular corporate income tax, then you have to pay the amount for the minimum corporate income tax. So beginning, of course, MCIT only applies at the beginning of the 4th year of operation. A domestic corporation and resident foreign corporation is taxed by whichever is higher between RCIT or normal tax of 30% or MCIT of 2% of gross income tax. So illustration number 6. A corporate taxpayer operated on its 5th year of operation has the following date. So remember that MCIT starts at the beginning of the 4th year of its following, 4th year immediately following at the year of its operation or registration. Okay? So in this case, in illustration number 6, the operation daw, the corporation that operated on its 5th year of operation. So, pwede siya or nag-start na si minimum corporate income tax in this case. So, the following data, gross sales, that's 15 million. My returns, allowances, and discounts. Cost of goods sold, of course. Deductions, interest income from bank deposit and rental income from vacant premises. So remember that interest income from bank deposits will not be included in the computation of the gross income because interest from bank deposits is subject to final tax because it is a passive income. Okay? So compute for the regular corporate income tax and the minimum corporate income tax and the tax due. So the regular corporate income tax or RCIT is as follows. So gross sales, 15 million less returns, allowances, and discounts. That gives you a net sales of 13,950,000 pesos less cost of goods sold na 6,750,000 pesos. you have a gross income from operation na 7,400,000. So, hindi to yung taxable income mo. Bakit? Because you still have other income, okay? With other taxable income not subject to final tax, which is the rental income for 60,000 pesos. So you add 60,000 pesos, that leaves you 7,260,000 pesos as gross income. Of course, less deduction for 3,375,000 pesos. The taxable income now is 3,885,000 pesos. Multiply by, of course, the 30% regular corporate income tax. Your regular corporate tax is 1,165,500. So again, the interest is not included because it is subject to final tax. This again, interest income is a passive income subject to final tax. Now, nag-compute na tayo ng regular corporate tax. Since sa fifth year na siya, fifth year of operation na siya, so nag-start na si MCIT. So we have to compute. So kailangan talaga natin mag-compute ng MCIT kasi qualified siya or he is a domestic corporation. So mag-apply si MCIT. Okay? So how to compute? Of course, gross sales na 15 million. Less returns, allowances, and discounts. That gives you a net sales of 13,950,000. Less cost of goods sold na 6,750,000 pesos. Gross income from operation of 7,200,000 pesos. Again, plus other taxable income not subject to final tax, which is the rent income of 60,000. That gives you a gross income of 7,260,000 pesos. Now, if you compute the minimum corporate income tax, hanggang gross income ka lang. Gross income ka lang. Hindi ka na pwede mag-deduct ng mag-less ng deduction na 3,375,000 pesos. Mag-apply lang si deduction class if you compute the regular corporate income tax. Pero pag nag-compute ka na ng minimum corporate income tax, si deduction no longer applies. So yung total gross income mo na 7,260,000 pesos, that is now your basis for the 2% minimum corporate income tax rate. That's your minimum corporate income tax is 145,200. Now, what is the tax due? Of course, yung tax due mo is the higher between the MCIT at saka yung na-compute mo kanina na regular corporate income tax. So it is obvious that the higher is the regular corporate income tax. So our tax due therefore is 1,165,500. Okay, so here are the entities exempted from MCIT. So, resident foreign corporations engaged in international carriers and so on. Resident foreign corporation or RFC in general. So, ano yung mga tax rates ba na applicable for resident foreign corporation or RFC? Of course, as what we have discussed kanina, mag-apply sa kanya si 30% regular corporate income tax only from income within the Philippines. And of course, mag-apply din sa kanya si 2% 2% minimum corporate income tax. Illustration number 7. The corporation is a resident foreign corporation, has the following data on its income and expense for 2019. So, ayun. So, ito yung income and expense for 2019. So, compute the taxable income and tax due, of course, because the corporation is a resident foreign corporation, we only tax those income within the Philippines. Okay? So, not included gross income from USA. Gross business income, Philippines, which is 7 million, less allowable deduction for 2 million, that gives you 5 million as taxable income. So 5 million taxable income times 30% tax rate, the tax due is 1,500,000 pesos. However, because meron siyang payments in the PH for the first 3 quarters for 100,000 pesos, you deduct that from the tax due. Therefore, your tax payable is 1,400,000 pesos. Okay, so passive income for resident foreign corporation. Ayan, so interest income from deposits and yield from deposit substitute trust funds, similar arrangement. So the same with the domestic corporation, which is 20% final tax. Royalties of all types within the Philippines, that's 20%. Interest income from foreign currency deposit. Different siya sa domestic corporation kasi sa resident foreign corporation, that's 7.5%. While for domestic corporation, this is 15%. Intercorporate dividends from domestic corporation is also exempt. The same with the domestic corporation. So remember that if a resident foreign corporation and a domestic corporation receives dividend from a domestic corporation, that dividend is exempt from income tax. Now, for capital gains, so sale of shares of stock not traded in the local stock exchange. So, unlike domestic corporation, which uses 15%, under resident foreign corporation, the provisions of the NIRC remains. Okay? So, if the gains or capital gain, or if the gains of the sale of shares of stock is not the tax will be like this one. So if the tax is 5% for not over 100,000 pesos, and for over 100,000 pesos, that's an additional 10%. So sale of real property held as capital, that's 30%, since there is no provision for capital gains on sale of realty. Okay? So for international carrier, you have a tax rate of 2.5% of gross Philippine billings. So si international carrier, sila na yung mga special non-resident foreign corporation. So of course, for gross, special resident foreign corporation, si international carrier. For gross 2.5% yung tax rate niya, applicable tax rate niya is 2.5% of gross Philippine billings. So ano ba si gross Philippine billings? Against international carrier, ito yung international shipping and air carrier. So planes, mga barko, ayan. So, the 2.5% tax is based on the gross Philippine billings. And a gross Philippine billings is a gross revenue derived from carriage of persons, yung excess baggage, cargo, and mail. Dapat, it must be, or the transport must originate from the Philippines in a continuous and uninterrupted flight, irrespective of place of sale and payment of ticket or passenger documents. So, without regard, no, kahit pa saan nabenta yung yung ticket niya, kahit saang lugar pa nabenta yung ticket niya, within or without the Philippines, basta it originates from the Philippines, okay? So, it will be subjected to 2.5% tax rate. So, passenger flights from any point in the Philippines and back. So, the portion of revenue pertaining to the return trip to the Philippines is not included in the gross Philippine billings kasi nga, only those income or sale of tickets related to flights or shipments originating from Philippines will be subjected to 2.5% income tax. Okay, so pag may ticket yung passenger pabalik ng Pilipinas, then yung income sa ticket na yon for a return trip pabalik ng Pilipinas will not be subjected to income tax. Offshore banking units, income from foreign currency transaction with non-resident, that's other OBU, local commercial banks, that's exempt. Now, to summarize, no, the foreign currency deposit, yung tax rate on interest income from foreign currency deposits, interest income received by, included na si individual dito, no, as a summary. So, resident citizen, resident alien, and domestic corporation, they will pay a final tax of 15%. So, interest income received by non-resident citizen, okay, OCW, and non-resident alien is exempt. While interest income received by resident foreign corporation is final tax of 7.5%. Now, bakit maliit si resident, yung binabayaran ni resident foreign corporation? Okay, this is to what? Para maengganyo sila na mag-deposit ng or pinaliitan yung tax na nababayaran sa kanilang deposits ng foreign money, okay, para to give them an incentive to deposit foreign money in the Philippines kasi nga maliit yung tax. Okay? So para magdaghan ato ang supply sa foreign currency. Kaya pinaliitan yung interest sa deposits, yung interest na babayaran. Okay, yung tax sa interest kay ng foreign money or ng foreign currency deposit. Okay? Bank account in joint names of an OCW and spouse. So 50% daw. So pag pag worker abroad ka, Filipino worker abroad at saka spouse mo nandito sa Philippines, 50% exempt and 50% subject to 15% income tax. You just have to multiply it by 50%. Okay? The result will be, yun lang yung babayaran mo ng final tax na 15%. Okay, now branch profit remittance. So the branch profit remittance tax is 15% of total profits applied or earmarked for remittance to the head office without any deduction for the tax component. Okay, so itong branch remittance class, ito yung tax na mag-a-apply if my branch or my branch ang isang company dito sa Pilipinas. Okay, so pag remit niya ng profit or before niya i-remit yung profit sa home office, okay, abroad, okay, so kailangan siya magbayad ng 15% tax rate, okay, without any deduction for the tax component. So exempt of course those registered with PEZA. Okay, so si branch profit remittance class, exempted yung mga registered sa Philippine Economic and Zone Authority. Okay, kasi class itong PEZA, okay, ito yung area sa Philippines na considered sila as foreign territory. Okay? So they are if they are registered with PEZA, within PEZA, then they are exempted from paying the branch profit remittance. Now, itong mga regional area headquarters or RAHQs and ROHQs, okay, so ano yung mga tax rates nila? So for RAHQs or regional area headquarters, they're exempt from paying taxes or income tax, while regional operating headquarters, they pay 10% on taxable income. So what's the reason nga nung si RAHQ is exempt and si RHQ is kailangan magbayad ng 10%? Kasi si RAHQ, it is not more on their establishment or their offices, no, in the Philippines is not more on operation. They are more on supervisory, communication and coordinating center. Kaya exempt sila in paying income tax. Okay? Pero si ROHQ, vital kasi yung mga regional operating headquarters okay, dito sa Pilipinas in earning profit. Okay? So ito sila so ito yung mga branch established by multinational companies engaged in any of the following. So may establishment sila dito sa Pilipinas for general administrative and business planning, for sourcing and procurement of materials, corporate finance advisory service, marketing, training, logistics, So iyon class, so this is vital no for their operation, no, in order for them to earn income. Kaya they are subjected to 10% tax rate, CROHQ.